So a great way to make more money is to save more money, and a great way to save money is to pay less in taxes. But unfortunately, knowing how to pay less in taxes isn't really common knowledge. Like, did you know the amount of time you've owned a stock before you sell it will determine how much taxes you pay on it? I sure didn't when I first got my Robinhood account and started day trading. Hey, don't judge me, we've all tried. I was shocked when I found the difference in taxes. If you didn't know the difference either, it's a great thing you're here, because not knowing the difference between a short-term and a long-term capital gain can cost you hundreds or even thousands of dollars. And the more money you make, the more money you could end up paying in taxes if you don't know how they work. When it comes to short-term and long-term capital gains, there are three key terms that you should know. Short-term is less than a year, so 365 days or less. Long-term is over a year, so over 365 days. And capital gains is the profit you make on an asset, which is things like stocks, bonds, cars, houses, things like that. But for this video, we're going to focus on stocks because I haven't looked into the rules and exceptions for the other things, and I'm sure they exist. Actually, I know they exist because I looked into them, but not enough to share that information confidently. If you only remember one thing from this video, it should be this: the taxes you pay on long-term capital gains are much lower than the taxes you will pay on short-term capital gains. And that means the taxes you pay on short-term capital gains can be much higher than the taxes you pay on long-term capital gains. The tax you'll pay depends on your income and your tax filing status, but I'm going to focus on the filing status of single. If you are single, the tax rates for the long-term capital gains for 2021 are 0% if your taxable income is less than $40,400, 15% if your taxable income is between $40,401 and $445,850, and 20% if your taxable income is over $445,851. Now, there are some exceptions, but most people will pay a tax rate of 0 or 15% on long-term capital gains. Tax rates for short-term capital gains are the same as regular federal income tax rates. Here's a chart of them in case you forgot. One important thing to know is that the shares of the stocks you buy follow what's called first in, first out, or FIFO. So let's say you have 10 shares of a stock and 14 months later, you buy 5 more shares. The clock doesn't restart for those first 10 shares you had. So if you go to sell like 10 shares, it'll be the first 10 shares that came in. So first in, first out. That was a question I had for the longest time, and so I thought I would share that with you. Thank you for watching. If you didn't know, April is Financial Literacy Month, and I had a goal of posting one video every day for this month. I am ending the series today because, honestly, I'm tired of making videos that won't get watched and aren't even searchable. I recently made a video on how much I spend to run my tiny YouTube channel, which right now has only 101 subscribers, and it made me realize that I'm terrible at getting views. I haven't been doing research so that my videos will even have a chance of showing up when you search something. So instead of just pumping videos out and hoping they get watched, I'm going to dedicate more time to learn how I can give my videos a fighting chance. Thank you to those that have been supporting me with this series. You know who you are. I really appreciate it. There's more videos coming, just not every day. Thanks for coming to my